Today's podcast is brought to you by Daloopa. Post-earnings reports are more than just a data dump. They're a goldmine of opportunities waiting to be unlocked. And with Daloopa, you can turn those opportunities into actionable insights. Daloopa's dynamic scenario building tools integrate updated earnings data, letting you model multiple strategic outcomes, like what happens if a company revises guidance upwards. And with automated sensitivity analysis, you can quickly understand the impact of key variables, like cost pressures, currency fluctuations, or interest rate changes. This means you'll deliver more actionable insights for your clients, helping them navigate risks and seize opportunities faster. Ready to enrich your post-earnings narratives? Visit daloopa.com/YAV today to get started. That's Daloopa, DALOOPA.com/YAV, or visit the link in the show notes. All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot always if you could rate, subscribe, review wherever you're watching or listening to it. I say that all the time, and I realize when you say something for almost 300 episodes in a row, you can start trying out. But look, the best way to get more of this podcast, improve guests, is to get more listeners. And the best way to get more listeners is word of mouth. And the best way for that is either you telling a friend you like this podcast, or rate, subscribe, review really helps kind of improve us in all the algos and everything. Anyway, that's my ramble, at the start of my ramble, because today is March 15th. It is a Saturday. Yesterday was March 14th, Pi Day, one of my favorite days of the year normally. Unfortunately, I'm doing a diet, so I couldn't really dive into pies as heavily as I'd normally like to, but it is March 15th, Saturday, and I am here to do my random ramblings for the month of March. Before I get into that, let me just start this podcast with a disclaimer, remind everyone that nothing on this podcast is investing advice. That is always true, but particularly true today. I'm going to ramble on for 20 to 30 minutes. So just remember, I'm literally just rambling. Please consult a financial advisor, not investing advice, do all your own work, all that sort of stuff. Anyway, it is Saturday, March 15th, and there are 4 different topics I want to talk to you about. The market sell-off, then relationships with management teams, pros and cons, and then 2 quick discussions on activism and corporate governance, and then an ending thought on kind of where to live. So let's start with the market sell-off. It is Saturday, March 15th. And the markets have just, over the past kind of 6 weeks, have just been absolutely brutal, just straight down, especially the Russell 2000 has just been straight down. I think somebody sent me something that said, like, kind of since late November, if there's been 15 weeks or so, the Russell's been down like all 15 or maybe 14 of 15. And none of that sounds like much. Look, as I'm taping, I think the Russell is down 10% over the past month. The S&P is down 6 or 7%. Doesn't sound like a lot, but I will tell you, underneath the headlines, especially in the S&P, I don't know what's going on with the indices, but I feel like there's just absolute carnage in a lot of the stuff I'm looking at, and it doesn't get reflected in the indices. Like some of these smaller names have just been brutalized for, in my opinion, no particular reasons. And then cyclicals, I've been saying for 6 months, if you invest in something with cyclicality, it is forecasting an absolute imminent recession. And, over the past 6 weeks, it's gone from imminent recession to absolute depression. So I wanted to start this podcast off with a few discussions of the market sell-off. And I will note, I put a post up over the week. I'll include a link in the show notes. It was on markets in turmoil. I say that kind of tongue-in-cheek, tariffs and rebalancing your portfolio. I say that kind of tongue-in-cheek because, look, things can always get worse, right? Think back to COVID, think back to the global financial crisis, but I would say sentiment feels pretty bad right now. It could certainly go to worse. We could, slap the tariffs up to 500% or something, but it feels pretty bad right now. So here are the things I wanted to talk about. First, just as an investor, it is your job to remain cool when things are going crazy. That is not to say, hey, if you own something that is levered to the gills and is going to be really exposed to tariffs or a recession or something, that is not to say you shouldn't kind of reassess and sell if something's clearly materially affected. But we all know stories of hey, my grandparents, during the dot-com bubble, the stocks went down and they sold all their stock, or during the savings and loan crisis of the 90s, they sold all their stock, they stuffed it in their mattress and cash, and they never made money because of that, right? Like, your job as just a general investor is stay the course, right? You don't want to be wildly fluctuating, going to cash because things seem scary. Just like, this is just a general thing. You need to stay the course. That's just the personal finance stuff that people are always talking about: dollar cost weighting, not taking your cash exposure to 100 because the market seems like it's going down. Like, now's actually probably the time to be being pretty aggressive, just based on how bad sentiment is and everything. So that's just one general investing type theme I wanted to talk about. I mentioned, look, the dislocation, and that's one thing I want to dive in here. The dislocation feels much worse than I'm kind of seeing in the overall indices, and I'm not sure why the indices don't appear to be reflecting that. Like, the S&P 500, look, a lot of the S&P 500 at this point is Apple, the FANGs, the Magnificent Seven, or whatever. They're so big and they take up so much of the indices that they really drive it. But even in the Russell, again, the Russell is down 10% over the past month. And if you ask me, like, gun to my head, I would have guessed at minimum 20%, just based on some of the moves and some of the stocks I've seen that have reported good earnings and seen their stocks go down 15, 20%. Some of the stocks that haven't reported earnings and have seen their stocks go down 20% or more. I'm just surprised. And so I think there's a decent bit of dislocation out there. And one thing that I am pushing myself on, and I think you need to do too, is you need to look at your portfolio really dispassionately right now. And you need to be looking at all your names and saying, hey, you should do this all the time. But I think it's particularly true during periods of dislocation and market turmoil. Look at it dispassionately and say, hey, I bought this stock for 100. Let's say it's at 95 right now, right? It might have been my best idea last month, but it's gone down 5%. And a lot of the other stocks I follow have gone down 20, 30, 40%. You need to look really dispassionately and say, is this really my best idea right now? You can't be anchoring to, I bought this at 100. I need to make money. Like, it's better to swap into the things that are more dislocated. Now, you have to balance this against everything, right? There are some trading costs. If you've got a really low tax basis or something, you've got to consult a financial advisor, I'd say, but you've got to consider taxes and everything. And you also, I'm not saying to do this willy-nilly, like a stock you follow really closely that you bought at 100 goes from 100 to 95. A stock you don't follow at all goes from 100 to 10. I'm not saying to go swap into that $10 stock, but if most investors I know have a group of, call it 20 to 50 names that they have a lot of knowledge on, a lot of institutional knowledge. I like to say, there's a lot of companies, probably 40 to 50, where I've followed them long enough that, I'm close to them. And if I think there's an opportunity there, I could probably be ready to do something on it in, maybe it's 24 hours, maybe it's a week. But, I think of companies where 2 years ago, I did like 4 expert calls. I read every conference call. I read multiple transcripts. I built out a model. I studied some of the competitors. Unless things have really gone crazy, I could probably be up to speed on that company with 48 to 72 hours of pretty focused work. And I think most investors have something like that. So I'm saying, if there's a company that's in your wheelhouse that you've done a lot of work on, like, you need to be looking at your portfolio against all those companies. So let's talk dislocation. Again, the indexes are down 10. The Russell's down 10% over the past month. I just pulled up some random companies that I've followed for a long time. Like Shift4. That's the one I'm going to mention that I have not followed, but I have so many friends who love that company. That's down, as I talk about this, that's down 30%. I mean, look, if you've done a lot of work on Shift4 and you think that's a great company, they almost sold themselves last year. I know that. Down 30%, like that's a big move. That's an opportunity. Exponential Fitness, very controversial stock. I've had people on the podcast to talk about it before. I think, disclosure, I might own like 100 shares that I put into a tracking account or something at some point. But that is now they reported really bad earnings this week, but that is down 57% over the past week. You want to talk dislocation? Have a controversial, somewhat levered company report bad earnings into a down 10% tape. Like, I will tell you, I have a model built out there. I could probably be up to speed on that. And you can go listen to the podcast I did. I have some questions on the sustainability of some aspects of that business. But, that is a company that is trading very cheap on the diminished forward expectations, I would say. Down 57%. Report bad earnings, be controversial, and have a down market. That's one way to get really dislocated quickly. If you like coal, most of the coal stocks I follow were already pretty cheap. They're down 20, 30, 40% over the past few months. The coal markets have been weak, but I think there's a lot of signs that coal actually the demand outlook might be somewhat improving. Obviously, you've got to differentiate between metallurgical and metal and thermal, but I think there's interest in there. Sphere, SPHR, they own the Sphere out in Vegas. That's one I mentioned in the article. That's down like 30% in a month. If I was like, hey, what is a business that's not going to be impacted by tariffs, that, the near term outlook shouldn't matter that much? Sphere is probably one I would list. Like, it's a big giant sphere that's built out in the middle of Las Vegas. It's going to be there whether tariffs are 100% or 700%. Now, advertising revenues might change. The ability to license the Sphere, which they've always talking about, and build Sphere 2 and 3, that might change. But that's one where I think you're probably buying the Sphere below replacement cost. You do have concerns on corporate governance, but there's one that's probably dislocated. Forward Air, the ticker there is FWRD. I mean, that has a who's who of activists in there. They did one of the worst deals of all time. I think last I checked, they were trading below what they did the deal for. There should be a lot of acquirers there. That looks pretty cheap versus the assets. Now, obviously, it reported kind of poor earnings. I think there's questions around corporate governance and all that sort of stuff. But that stock is down 35% over the past month or so. So I'm just listing some things that are dislocated that could be really interesting. Some of them I've done quite a bit of work on. Some of them I've done little work on. I don't believe I really own any of those, but just some things that could be interesting. Always happy to swap thoughts with people. But look, again, just to wrap this up, there's a lot of dislocation out there. I just listed 6 stocks that could be quite interesting that are all down somewhere between 20, most are around 35, and some of them approaching 50%. I think if you've got a portfolio and it's held up well, or even if it hasn't held up well, if you're not kind of looking around and saying, hey, are there better opportunities out there? Can I swap into better things? Like, your job as an investor is always to weigh opportunity costs, and in particular in dislocations, swapping into things that have been beating down. That is one of the ways you can really outperform. You've got to, yes, there's 1,000 other things to consider, but I think that should be top of mind right now. In terms of the market environment, look, tariffs suck. I feel like we're kind of, I don't know if anybody's, I don't know. I'll refrain from commenting politically, but market sentiment feels really, really bad right now. And the one thing, just to come back to the dislocation and the cyclical thing, post-COVID and with the COVID boom, most of these companies, like, there was this huge gusher of cash flow. And I think one of the things that's different today versus, say, 10 years ago, if we're heading into a recession or whatever, most companies used the post-COVID boom and the cash flow gush that they got to reshape their balance sheets. I used to point to US Steel. Heading into COVID in the last recessions, they had a decent bit of leverage. They had this huge cash gusher, and they basically paid down all their leverage and went net cash. So, in prior recessions, you'd say, oh my God, US Steel's leverage goes from its 2 times EBITDA. Their leverage goes to basically infinity because they're not earning anything. And all of a sudden you're like, look, if this recession lasts 18 months instead of 6 months or something, US Steel might have bankruptcy risk or restructuring risk or something, right? Today, and I haven't looked at US Steel in a month, but I believe their balance sheet is just completely transformed. Last time I looked, they had no net debt, basically. They are still in a weird deal with Nippon, if I remember correctly. But, today, if they went into a recession, I would say, oh, there's no doubt that US Steel is going to come out on the other side. Now, they might burn cash for the next year, 2, 3 years if things were terrible, but they're going to be able to come out because they have no debt, right? So, yeah, maybe they'll have debt at the end of it if they're burning cash, but I just think these things are completely transformed. And people say, oh, US Steel drops by 50% in a recession. I'd say, oh, well, yeah, but they were 2x levered then. So their stock would drop because people were starting to adjust for bankruptcy risk. And, if they had $800 million of equity and $200 million of debt, the stock would drop 50% because on an EV basis, that was $1 billion. Their stock's kind of only dropping 40% if I'm doing their EV is dropping 40% if I'm doing that math in my head roughly correct, or 33%. If they have no net cash now and their market cap's 800 million, if the stock drops 50%, well, then their AV is actually dropping 50%. So it's like, hey, they should drop less just because they don't have any debt. So you don't have those bankruptcy risks and the EV is all equity supported. So I think a lot of companies are in a much different place today than they were historically. And I think that sets all of them up well to weather any short or medium term storm. Now, that's not to say things could get way worse than I'm talking about, but a garden variety recession, a one-time hit caused by tariffs and stuff, just about every company I follow would be able to weather it. I'm sure you could point to a few different one-offs that, they have a lot of leverage for one reason or another, but most companies I follow have dramatically better balance sheets than I've ever seen them have before. So I think that's one other kind of margin of safety or thing pointing there. Okay, anyway, speaking of dislocations, one thing I've been thinking about a lot recently, and this is me personally, is developing relationships with management teams. And let me back up. I think my biggest flaw as an investor is I am slow to rip the Band-Aid off and cut the cord when a thesis goes against me. And I'm really working to improve on that. But, I buy a stock at 10 and I say, hey, this company is going to be growing. Earnings are going to be growing. Cash flow is going to be great balance sheet. And then they report a bad quarter and the stock goes to 8. And I say, well, earnings aren't going to be growing anymore, but now it's trading for a really cheap multiple. So now instead of having this growth story, I'm here for a cheap multiple story, and, on and on and on. And I call that thumb sucking. And I think that's my worst trait as an investor, just not being willing to cut the cord. And I kind of talked about it a little bit in my book club on advanced portfolio management I did with Bern Hobart, where, I used to laugh at people who use stop losses, right? A stop loss where, hey, if the stock goes down 20%, I'm out. And increasingly, I see the logic in that, where it's like, hey, a stop loss is a way to keep you from thumb sucking, right? The stock goes down 20%, and you probably want to adjust it for market moves and everything, but the stock goes down 20% is a way to say, okay, my thesis is broken. I'm going to sell. And then if I want to be invested in this company, I need to kind of like actively re-underwrite it and actively buy the stock, reassess my opportunity cost, right? So why did I mention this? I have noticed my track record when I form good relationships with management teams. And, there were type of relationships where I talk to them, obviously after every quarter, but, we have each other's phone numbers. We might text about the industry or something. And I'm not saying I'm best friends with them. I can't think of any publicly traded companies where I've become like that close of friends. But, the management team who they come to dinner, they come to New York once or twice a year, and we're going to go grab dinner, or we're going to go grab a coffee or something. We're talking a lot. And, when I call them and say, oh, hey, like I remember you said this in Q2 of 2023, how's that changed now? My history, when I look at it kind of dispassionately, is when I form a good working, almost friendship relationship with publicly traded management teams, my results have been worse than when I'm just kind of dispassionately reading the calls, reading the transcripts, reading the filings, and building my model, and maybe thinking for myself. And I wonder if it's very small sample size, right? But I have been wondering, I've been talking to other investors about like, hey, when you form a relationship with management team, how have your investments gone? Have they gone better or worse for you? And I'm wondering if forming a relationship with management teams for me is something that can contribute to my thumb sucking tendencies, right? Because the company reports a bad quarter, stock's down, and I could re-underwrite my thesis, and I try to, obviously, but I can also say, oh, well, I talked to the CEO, and yeah, it was a tough quarter, but this is industry-wide, and XYZ reason, and they replaced the head of sales and all this sort of stuff. And it's very easy to start sucking your thumb. I think the most famous example of this is in Valiant. Ackman, when all the fraud allegations come out against Valiant, he sends Mike Pearson, the CEO of Valiant, that famous email, Mike, is there any fraud going on here, right? And you can't email a CEO and ask if there's any fraud going on. If there's fraud going on, the CEO is never going to tell you. And if there's not fraud going on, well, cool, then he's telling you the truth. But it's kind of a loaded question, but it's the type of thing where you become very good friends with them. And I think it's very easy to outsource your judgment and your due diligence to that friendship and the person versus doing your own. And one other thing I'd say is CEOs, is even founder CEOs, but CEOs generally become CEOs because they are very good salespeople. And I don't necessarily mean that in terms of the closing deals on the dotted line, but you become a CEO because you build the internal political capital in some way, shape, or form to get promoted to CEO. And I have found, especially CEOs who have come to know quite well, sometimes they understand how to play investors and how to play boards and stuff, and they're very good at it. And they are very good at telling you what you want to hear. And there's a reason they got promoted that, right? And as an investor, your job is a lot more, it's both quantitative and qualitative, but most investors are running small funds. They're working with a handful of analysts. They're working by themselves. They're individual investors. Yeah, maybe they're at Fidelity, but even if you're at a big firm, you're working with a handful of investors. If you're a CEO, you're working with dozens and dozens of people, 5 to 10 board members, 3 to 7 direct reports, maybe hundreds of people underneath them. Like, they're probably much better at getting political buy-in and selling than you are. And I think there's the famous quote, how do you beat Michael Jordan? You do it by not playing him at basketball. If you're playing games of salesmanship and friendship against CEOs, I think they're probably going to be able to win that game. So it's just something I've been debating, like, hey, do I stop trying to form, not that I can't have a good working relationship or discuss companies with CEOs, but I wonder if even that, like Walter Schloss famously just invested from a room, like a cold room. I wonder if that is better, and you just kind of say, hey, I will judge the CEO and the company on the actions that they take and the numbers they report. I don't need to get chatter from them about chatter and commentary for them, because chatter and commentary can be lies. It can be skewed. What they put on the paper, yes, it could be lies as well, but that's going to be a lot less biased, and you're going to have a lot less, you're going to have to make the interpretation for yourself versus having them spoon feed it to you in a way that's probably positive for them. Okay, I've been rambling for a while. My hope is that going from market dislocation to talking about some thumb-sucking relationship with management teams, that's a smooth transition. And speaking of relationships with the management team, hopefully a smooth transition here is just a quick thing on activism and corporate governance. I was talking to a friend the other day, and when you start getting into corporate governance, it can get a little bit addicting in a few ways. First, there's the Mike from Non-Gap. There's the famous thing. Once you start seeing the dark arts of corporate governance, how corporations and boards can spring load grants to enrich themselves before good news comes out and everything. Once you start seeing the dark arts, it's kind of hard to stop. And I would also say once you start seeing like kind of the dark arts behind boardroom politics and how these companies manage to entrench their directors and stay in control, it's kind of hard to stop seeing that as well. So I was talking to a friend, and we were talking about how once you start looking at these it starts to get hard not to look for them. So anyway, I mentioned this because last month I published a podcast on Sage, which I disclosure am quite long that stock, talking about, hey, here's the reasons I think this company needs to engage in a sales process. I believe in good active ownership. If you own the stock and you agree, you should send a letter to the board. Or if you don't agree, send a letter to the board and tell them that too. And try to lay out my rationale. One of my goals, I just want to note for this podcast, is I increasingly want to do stuff like that, right? Like if you are long a company and there's a clear corporate governance problem in some way, shape, or form, I want to use this podcast to shine a light on that. I'm not saying I want to start driving hard activism at every company in the S&P 500, but especially smaller cap companies. When you start doing this work, smaller cap companies get away with a lot of crazy stuff. These boards of directors often have no stock ownership. They pay themselves crazy amounts of money for disastrous work. And for many of these companies, I could point to as an outsider, I could point to multiple things that I think could be changed or improved that would improve economics, improve economics, improve the share price, all this sort of stuff. But you know what it might do? It might make the directors' lives slightly more uncomfortable, and they're not willing to do that because that slight uncomfort outweighs the millions or tens of millions or hundreds of millions of dollars of value they create. And again, I'm not saying for all of these, though for many of them they should. I'm not saying for all of these, it's, hey, you need to sell the company or you need to do a huge cost cutting round. Like for some of these companies, there are many simple operational things that if you spend 2 days researching the company, it's clear they are behind in one operational thing or another that they could improve. And because the management team is lazy and unmotivated, and because the board isn't willing to look into that, the operational things take much longer or never happen than they should. So increasingly, I want to use the very small platform and the dozens of listeners I have to shine a light on these situations. Generally boards who don't own stock, companies that need to do one thing or the other. Sometimes it's sell, sometimes it's just cut costs, maybe reduce the hugely inflated pay of some of these boards and management teams. And I'm not saying all, but many in the small cap world have it. I want to shine a light on those. So, I guess what I'm saying is, if you are a informed shareholder and you've got a company that fits that bill, reach out. I'd love to chat and find a way to make that work. And it would be nice if this podcast was one way to slightly improve corporate governance, outcomes, everything there. So keep that in mind if you're interested or if you have anything else. And then, okay, last thing to ramble on. My wife and I are thinking about moving from New York for a variety of reasons, taxes and cost of living being a massive one. So we are thinking about that. My friend Artem Fokin is always trying to drag me out to California, and I know he listens to this. So I don't think California is on the list, because you move from New York for taxes and cost of living and you go to California, it's kind of like, hey, you went tomato. But I mentioned that just to see if Artem's listening. But one thing I have thought about is, where would a young Warren Buffett live, right? Warren Buffett, obviously, he lives out in Omaha, loves it there. I think family ties, he grew up there, all that sort of stuff. But if Buffett was 21 and just starting his career out, I wonder where he would live. I doubt it'd be in Omaha for tax reasons and for all sorts of other reasons. I doubt it'd be in New York. I mean, maybe the financial network in New York is so powerful that, there's a reason a lot of hedge fund managers, everything. But I wonder if a young Warren Buffett, people might say Austin, people might say Miami, low taxes, still domestic, Puerto Rico. And I think low taxes would be a consideration. But I do wonder, would they go to, one of the tough things as a domestic investor investing internationally is you often don't understand the international landscape. One thing I've hesitated with when I've looked at, there's a lot of Asian and African companies that look crazy cheap to me. But when I do the work, I'm like, I don't really understand the geopolitics there. And I worry that if I invested in it, I would be the sucker at the table. And, 6 months from now, somebody would be like, hey, that's a great company you invested in, but they've got mob ties. Or, hey, you invested in that company and then the government said, hey, that's a great company. We're changing the rules so that all of their profits become our profits. I worried I'd be the sucker at the table. I wonder if a young Warren Buffett would say, hey, there are so many inefficiently priced small caps in Asia. I'm going to go live in Singapore. I'm going to go live in Thailand, something like that. And I'm going to really have my boots on the ground. And that's where I'm going to develop my network. And those are the fastest growing economies. So I'm going to develop my network over there and really have my the pulse of kind of the economy the economies and markets that will be the fastest growing in the future. I don't know, but again, I don't know. I don't know Warren Buffett, but it's just something I'm not moving to Asia, but it's just something I've thought a lot about of, hey, for me, wherever we move, I want to be optimal for work. So, it's got to have access to airports, finance markets, all that type of stuff. Low taxes and cost of living obviously be a consideration. But if you were young and single and just infinitely hungry, I don't know if the answer would be to live domestically. I wonder if there would be more opportunity to go and live in Asia and get boots on the grounds in a really unique way and invest in unique markets and build a more unique network. I don't know. I'm just rambling. Anyway, I think I've actually been rambling for 25 or 30 minutes. Maybe my ramblings are getting longer in my older age. So again, March 15th, 2025. I will wrap it up there. Oh, with one last note. I will try to do a rambling before, but I'm going to Planet MicroCap in Las Vegas from let's call it April 21st to April 24th. I have been 2 years in a row. It is one of the highlights of my year. I have so much fun. It is a really unique group of people because there aren't a lot of people who invest in microcaps. So if you are going, you should reach out and let me know. I'm going to plan some fun dinners, all that type of stuff. Just come say hello, and I can include you in that. And if you're on the fence about going, I've been trying to push everyone I know to go, because the more, it's one of the fun things about events. The more people who go, the better the network, the more fun it is, and like the better the cycle spends. So if you're on the fence or something, you should come. If you're on the fence, reach out to me and I'll chat with you and we can talk. I think it's going to be a lot of fun. Obviously, you need to have some interest in micro-cap investing or value investing. Like I'd say the both, because even if you say, hey, I don't invest in microcaps, I think if you come and you meet like 50 value investors who have interest in microcaps, but maybe you're interested in other stuff, I think you will have a lot of fun. I'll try to make sure of it, but I have a great time every year. And just wanted to mention that. Reach out to me if you want to chat or if you're going, so I can include you. I think that's going to be a ton of fun. And I mentioned that because I'm not sure if I'm going to do a random ramblings before or after that conference, but there you go. That's my random ramblings for March. It is March 15th. I'm logging off, and I will talk to you guys before next month because we've got some great podcasts coming up this week, but I will talk to you soon. Bye. Today's podcast is brought to you by Daloopa. Post-earnings reports are more than just a data dump. They're a goldmine of opportunities waiting to be unlocked. And with Daloopa, you can turn those opportunities into actionable insights. Daloopa's dynamic scenario building tools integrate updated earnings data, letting you model multiple strategic outcomes, like what happens if a company revises guidance upwards. And with automated sensitivity analysis, you can quickly understand the impact of key variables, like cost pressures, currency fluctuations, or interest rate changes. This means you'll deliver more actionable insights for your clients, helping them navigate risks and seize opportunities faster. Ready to enrich your post-earnings narratives? Visit daloopa.com/YAV today to get started. That's Daloopa, DALOOPA.com/YAV, or visit the link in the show notes. A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.